Hi, Tony. Thank you for joining us today. I'm really excited to have you here. I'm obviously very familiar with you. We've done some work with you and me, and I know how good you are, and I understand your expertise. But for people who don't know you and are going to listen to us, do you want to give us a sense of who you are and what we're going to be talking about today?
Absolutely. And firstly, Yannick, thanks for inviting me along. Much appreciated. So I've been running an accounting and advisory firm for 25 years. We're based locally here in Carlton in Melbourne. And we specialise in property-related industries. So whether that's investors, developers, builders, even architects, real estate, etc. So we're a very property-centric accounting and advisory firm and have been doing it for a long time. And good to be able to chat with you about property investment and structuring, and particularly with high yield, with a focus on high yield investments. Run through and tell your listeners all about it.
All right, let's have a chat. Look, I was keen to for this particular episode or this particular afternoon with you. I've been helping property investors for 2 decades now, and I consistently see the same stories that the property takes all the light. People forget about the fact that the property is a mean to an end, typically, that end being making money, whether it's for retirement, whether it's for lifestyle, it doesn't matter. And it's very poorly understood, I think, among the general pool of investors, how much of an impact on the net outcome from an investment the structure and the tax wisdom has on the outcome. I think it's also poorly understood that, and you'll set me straight on that one, but at the best of my understanding, you have only one chance to structure things properly when you buy a property, and that's at the time of purchase. And then once it's done, it's done. Right? And we get people who are getting close to the exit, and that's when they realize all the tax they're going to have to pay, and it's too late to do much about it. It's very hard to get people to focus on the less shiny, exciting things when they go through a property purchase, such as the finance or the tax. And I was really hoping that today we can go through a bit of information that might actually sort of really make that obvious to prospective investors and grab their attention toward the tax conversation, because it really doesn't show itself until you get right to the end. And then that's when you start to realize what the tax bill might be, and you go, wow, that's a lot of the money that I've been making. So same properties, same return, different tax structure. The net result can be dramatically different from what I've seen and experienced. And I was hoping that you can help us through sort of, those twists and turns and shed some light on what's what and how we go about it. So I'm going to give you the floor. And if you want to sort of give us your overall thoughts, and then we can start digging into some of the specific topics that we've got lined up for today.
Absolutely, Yannick. And you're quite right, because the general population out there don't really understand tax structures and the impact it can have. So, 2 people can buy exactly the same property for exactly the same price, have it in a different structure, and end up with a significantly different net return, as you touched on a moment ago. So obviously structuring is key, and it's something that should be done up front in terms of the planning, So it's not just focusing on the price and what price can I, what deal can I get for this property, or the location, or, how many bedrooms it might be, or what I'm going to rent it for. The structure is as important as any of those aspects. And so, particularly from an investment, obviously owner-occupiers are a totally different thing, but from an investment perspective, someone should be sitting down and really considering, what is the strategy here? What am I purchasing? How long am I going to hold it for, likely? Am I going to be renting it for the entire time? Is it a genuine investment? Yes. Okay, what does that look like then from a structure perspective? And so obviously there's a couple of key structures from a property investment point of view. I'm happy to run through them now if you're...
Yeah, I think that would be ideal. Again, I have a limited understanding of those things, but that's what we're hoping to do today. So if you want to take us through the usual suspects, if I may call them like this, we might leave the really complex stuff sort of out of the way, but I understand 90 or 95% of people would fall within a pool of, 4 or 5 different structures or options. If you want to work us through those at a high level, so, we can get a broad understanding of what's what and what they do and what they don't do, and, what's good, what's not so good about them. I think that would be invaluable for most of our listeners, yes.
Yep, no problem. So the first structure, which is probably the most common for the general population out there, is to buy a property or an investment in your individual name. So that's, you, Joe Smith, going out and signing a contract for the acquisition of that property. Now, that might be suitable in some circumstances, but again, it's a matter of understanding, what your intention is with that property and what the strategy is. Is it a short-term, long-term hold? Is it going to remain an investment for the entire time? Are you looking to potentially, move into that property at some point in time? Understanding what your income is and what it's likely to be going forward in the at least foreseeable future has an impact, because to have it in your personal name, it generally suits lower income earners. If you're a high income earner, then obviously the tax implications are going to be more significant, because that's going to end up in your personal tax return. So that's obviously a key consideration of tax. Asset protection is also a consideration. And so if you personally or may potentially be subject to any litigation in the future, or you're running a business, then asset protection is going to be key, because you don't want your personal assets, such as your investments, to be affected by other, business implications. So asset protection is important. And then there's sort of future family planning as well, because that asset is going to remain in your name. How do I potentially get it into somebody else's within the, family, or the intergenerational transfer? So it's generally not suitable, particularly for high-yielding assets, because you're going to have the tax implications, you're not going to have the asset protection, and you're not going to have the ability to be able to transfer it to other family, should you wish to, down the track. So whilst it's the simplest, and you might save on some compliance costs, because there's no trust deeds or any significant compliance, and there's a lower land tax implication as well. It ticks all of those boxes. But if we're talking high yielding assets, we're generally talking sort of larger assets, so it's probably not going to suit that structure.
I understand. So that would be a case of, if you had a property that was on the low yielding side of life and maybe with some bigger tax benefits, then that might make sense, because you'd be able to offset your high income versus that particular sort of losses you make from the property. But if it's a high yielding property, then it's going to actually add to your tax burden, because it's actually making money.
Correct.
Yeah, okay, yeah.
Absolutely.
Yeah, no, I understand. Okay.
And just on that point, traditionally there would have been, tax accountants in the past say to high income earners, yes, go out and buy a property in your individual name and you can negatively gear that property and you can save tax. Now, that might be great in the first couple of years, but once that property then becomes positively geared, it's going to affect you. Yep. And the longer you hold a property, as I said, obviously the more tax implication.
Yep.
And then obviously when you go to sell it, there's the capital gains. So whilst individuals get access to a 50% general CGT discount for holding a property for more than 12 months, it's still going to have an impact if you're a high income earner.
Yep.
Because all of that profit gets reported in your personal return.
That makes absolutely perfect sense. And I really appreciate you raising the estate planning component as well. I think that's something that's often overlooked as well. And I've dealt with the later stages of that conversation, where we work with families where assets are starting to be passed on to the children. And when things weren't structured the right way, again, people are absolutely shocked at the cost of transferring assets efficiently, which is something that is very there's very little awareness of that with people sort of purchasing investment properties, and I've seen that personally with number of clients. So that's an extremely good point you're raising there. That's fantastic. So that's personal.
That's personal. So the next structure, which is generally speaking probably the most popular nowadays, is a trust. Now, when we say trust, there are various types of trusts. There is a discretionary trust, otherwise known as a family trust, or commonly known out there as a family trust. And there's a unit trust. So they're probably the two most popular. There is a hybrid, which is not so popular, but generally it's either a unit trust or a family trust or discretionary trust. Now, where there is just Joe Smith predominantly acquiring the property, then he would likely acquire that in a discretionary trust rather than a unit trust. A unit trust would be more applicable to a joint venture or multiple people entering into an acquisition for, say, maybe a larger property. So if we look at, Joe Smith and the individual purchase, it's generally done through a discretionary trust. Now, a discretionary trust essentially gives you the ability to be able to distribute income, the net rental income whilst you hold the property, and even the capital gain down the future if you sell the property. And by virtue of the fact that it's discretionary means that you can distribute that income how you see fit within your family network. So you might have a spouse, you might have children, siblings, parents, etc., who are on lower income thresholds, or combined, you can spread it wide enough that you're all sitting, underneath the top tax threshold, for example, and therefore saving tax. Because, as we said, if it was in your personal name, it all comes to you. If it's in a trust, you have that ability to distribute. And a discretionary trust is the most flexible and the ability to be able to minimise your tax. It obviously gives you some asset protection because with a corporate trustee, you are protected because no one beneficiary of that trust has indefeasible right to that property. So no one can attack it and say, oh, well, Joe Smith bought that property. Well, he may have purchased it, but he did so through a trust. So the asset protection element is there. And the passing to family and the wealth transfer of that asset and any other assets within that trust environment is easier as well. So it ticks all of those boxes. I suppose the only potential downsides are land tax, because the State Revenue Office, particularly here in Victoria, have nicely levied a trust surcharge on any land held in trust. So that's probably the only key downfall. I mean, obviously there's the compliance costs of setting up the trust deed, maintaining that, but the cost of that pales into insignificance when you consider the tax advantages. Yeah. So net, you're going to be significantly better off on a high-yielding asset in a trust structure. As I said, unit trust, that really is two or more people sort of coming together to acquire, and a unit trust is generally fixed by virtue of the percentage of units you hold in that trust. So again, it's a fixed distribution to the beneficiaries, but this is where we might, and typically do, if we're setting up a unit trust with, say, two unrelated parties, we would have their particular units in that unit trust held by their respective discretionary trusts.
Makes sense.
So it's just an extra layer on top to be able to bring two or more people together. But essentially they're holding their individual units within their discretionary trust.
Yep.
So again, the same things apply as I've just run through from a discretionary trust point of view.
Understood. So basically, joint venture, syndication, unit trust, family business, sort of one family unit purchasing, family trust, which is discretionary. If I heard you right, I'm paying an absolute fortune raising 3 boys at the moment, but eventually I might be able to get some of that money back by being able to distribute some income or profit from a property portfolio to them and pay less tax on the money that I've made from the said property. One question that I would like to ask you, because this comes up a fair bit when we talk to clients, and I'm obviously not in a position to give them that advice myself, but say that I've set up a family trust and I went to purchase a high-yielding property. Everything is going great. I want to buy a second one. Am I setting up a different trust? Do I acquire it with the same trust? Is it a matter of shades of grey, or how do we look at multiple properties? Do they require multiple trusts, or do we stick to the one, or how do those things work?
It really depends on what the strategy is for that particular properties. We have had clients who have said, well, this is what I want to do with this. This is my long-term vision for this property. This is my long-term vision for this, and they're maybe a little bit different. So we have, on occasion, set up different trusts. Typically, if it's a similar type of strategy, we will suggest that they use the same trust. So it's not setting up different trusts all the time and then having the multiple compliance issues. Because the other thing is, if land tax is applicable, which typically it is, you've got that trust surcharge, and that trust surcharge cuts out at $3 million land value. So if you have multiple properties, then you're not actually paying the 15% extra surcharge.
Understood.
Typically, we would suggest you can use the same trust. And whilst we're talking property, I mean, that trust can hold other assets as well. So it can hold multiple properties and other assets.
So you could have your share portfolio and other things owned through the same vehicle.
Correct.
So that becomes very efficient from a cost perspective, and that makes perfect sense.
Yeah, absolutely.
Right. So we've got personal, we understand that now. Trust, we understand that now. Are there any other vehicles that sort of stand out in terms of investment or ownership?
Yes. Well, the other one, which many people don't really consider, is a self-managed super fund. So superannuation is the most tax-effective vehicle, and obviously, if you're in an industry fund with a lot of people out there who are, PAYG employees, will have their money just go into an industry fund, you do have the ability to set up your own self-managed fund. And so you can acquire property in a self-managed fund. The difficulties or the challenges around that will be things like lending, because there's a limited recourse borrowing arrangement that's required with self-managed super funds. There's a lot more compliance because the government and the ATO in particular want to make sure that they're protecting your retirement monies. It shouldn't be seen as some sort of plaything. It's for your retirement. So they're typically suitable for long-term investments. Investments that you are going to likely hold until retirement. So if you're a 25-year-old, you probably don't have a lot in your super anyway to be able to necessarily go out and do that. But, if you are sort of later in the working journey and not too far away from retirement, then, obviously a self-managed superannuation fund is a good structure. It's a good structure because whilst it's in accumulation mode and you're working, it's concessionally taxed at 15%, the income, which is a lot lower than the marginal personal rates. And any capital gain is at 10%, which, again, is lesser than any personal rates. And the real kicker is it's 0% tax when you get to retirement and it becomes pension phase. So there is, some significant benefits to be had from a tax perspective with regards to that. And again, from a wealth creation, wealth planning, family strategy point of view, your super is ultimately going to end up with your beneficiaries anyway. So again, that's a good one to work towards. As I said, the only issue with that is if you were to acquire that property, sell it after 5 years and make a lot of money and think, oh, great, I've got all this money, I can go, buy my new car. No, you can't, because
Yeah.
the money has to stay in the superannuation fund until you retire. So that's probably the only restriction. And I know that some people, when they think property investment, are probably thinking more short-term than long-term, which I know is sort of a strange scenario,
Perfect.
but they tend to think, well, if I can make a lot of money after 5 or 10 years, I can then use that money to go do something with. Now, as I said, it depends on where you are in your journey, you know. If you're getting close to retirement, you can pull out that money when you're in pension phase. So there's a couple of little pros and cons there, but it is very much tax effective, and obviously completely asset protected, because no one can attack your superannuation.
That makes perfect sense. Just maybe for people who are really unexperienced with self-managed super fund, a few key items. I've seen a lot of clients doing this as a couple, so this is something you can do with sort of a couple of people, as I understand it. When you put those people superannuation together, from your experience, how much superannuation needs to be accumulated between the proposed members of a self-managed super fund for it to actually make sense, you know, from an economical perspective, I suppose?
Yeah, and that's a very good question, and I suppose that depends on what you're intending to invest in. So if we're talking property, then typically we're going to need, 20 to 30% of the property value, because we're going to have to probably put that money in to get the lending.
Yep.
Now, there are some exceptions where you can go a bit lower, but you're paying a slightly higher rate. But, again, I don't profess to be a finance broker, so I won't go there. But what we sort of suggest is you need to make sure that you have enough for a deposit, and you have enough for some liquidity within the fund to manage, the ongoings, or the outgoings, I should say, with regards to the property and with regards to the self-managed super fund itself. So, we would suggest that, if you're buying a $1 million property, then, you'd probably want to have 300,000 to 400,000 in there.
Perfect.
Obviously, if you're looking to buy something significantly larger, then, you would need more.
Yep. That sort of 30% plus of the proposed acquisition would be a starting point.
Yeah.
And that can be between a number of people that can combine their superannuation.
So you can have up to 6 members in a self-managed super fund. So 6 family members can be involved. And, if you've got mum, dad and a couple of kids that might be working, it's a good, family, scenario.
Very, very powerful. Great. Tony, is there anything else you think we should cover as part of this conversation for people listening?
Well, that's probably it in regards to the structures. And as I say, in sort of summing up, the trust structure is probably, we're finding anyway, particularly, with our clients and our network, that it's the most popular. On a very rare occasion, an individual, personal acquisition. But we do have a number of clients who have their own SMSFs, and we certainly have acquired property, or they have acquired property within their SMSF. So
that makes perfect sense. Maybe to close, if someone is listening and has been considering investing in property, and they've found this to be relevant, so they've had a bit of a eureka moment listening to us and going like, oh, gee, I really should look into this. What would be the next step? Where do they find you or your team, and how is that going to look? Do they contact you and come to you, or what's the next step? If I'm now at that stage and I'm going like, oh, this is definitely something I should look into, what's my next step? If I want your or your team's help in sort of assessing my options and sort of working out what I should do.
Yeah, well, they can reach out to me directly. All my contact details are on my website at ADpartners.com.au. Obviously, I have my LinkedIn and Facebook and social pages. They can get me on directly. Certainly feel free to reach out. We're happy to have in-person or virtual meetings in this day and age. There's probably more virtual than there is in person, but we're happy to have either, depending on what suits the client. We're nice and centrally located in Carlton, so just on the CBD fringe, so easy to get to. And we're happy to have sort of a no obligation initial chat, and they can take it from there. I suppose the only other thing maybe worth mentioning, if you wanted to mention, was the government's recent change and recent push in terms of what's been referred to as Class 1B properties. And Class 1B properties are what you might consider to be rooming houses, boarding houses, etc., where that's low value accommodation, long term, and it's obviously this push to get more and more housing out there, more and more people into housing. Given there's allegedly a housing problem out there, so the government are now introducing some land tax exemptions for such properties, Class 1B. But there's some eligibility requirements as there is with everything. So we need to make sure that one, it fits the criteria. It needs to house at least 4 people, up to 12. And as I said, it needs to be more your long-term rental accommodation, not Airbnb, short stay type stuff. There is a slight leeway where at least 80% needs to be that long-term accommodation. And as I said, there's certain compliance things that need to be ticked off, fire, safety, et cetera, disability access and all of those sorts of things. So once you tick to those boxes, then you might have a Class 1B property. But to be eligible for the exemption, it needs to make sure that it's being used as such. So, as I said, it needs to tick that box about long-term accommodation. So if you tick those boxes, then you can get a land tax exemption, which in Victoria at the moment, given the rates of land tax, would be a big win.
Yeah.
And where one of the only downsides of holding property in the trust was the land tax trust surcharge, well, you won't have to worry about that at all. So for anyone out there who is considering, what type of property should I invest in, what's going to give me the best sort of returns, then maybe they should be, considering that type of property, because as I said, the government is certainly looking to give those incentives. And given the amount of people, the amount of investors out there who have reportedly exited the market because of land tax constraints, well, maybe we should just be considering, the type of properties that we can get involved in.
That's an excellent point. And for the benefit of people listening who may not be entirely familiar with what we do on our side of the catch, co-living properties that we promote, we only work with 1B classification, which we think is absolutely crucial for the reason that you've just mentioned, but also because the people who are doing it sort of on the cheap without achieving that level of certification expose themselves to some very serious penalties. So 1B for us is an absolutely non-negotiable item in terms of what we do. And that land tax exemption is an incredible benefit of those properties that you mentioned, particularly in Victoria where it's so steep. It makes a very big difference to the overall cash flow and the net outcome of any given investment, especially as the portfolio grow. And our business is in growing large portfolios, so this is extremely significant. So thank you for raising that. That's a very important point for people who are entertaining co-living properties. So that's absolutely perfect.
Yeah, and again, I think it's all about taking the time at the beginning to understand what your strategy is. Why are you even contemplating property investment? Is it because you just love property? Is it because, your family has traditionally invested in property? So understanding why you're doing it, and then what's going to give you the best outcome. Yep. What type of property, location, therefore, you then get into structures. What should I be doing? How should I be doing it? Who should I be engaging with to get the right advice? Obviously, they should be speaking to you about the Class 1B properties, and they should be getting tax advice, legal advice, all of that sort of thing. They should be speaking with brokers in terms of how much money can I get, what could I potentially purchase. So all these conversations should be had at the beginning.
Upstream.
And they should be really clear. That way they can really narrow down the market in terms of what they're looking for, and they'll get there a lot quicker.
It's going to optimize the outcome for sure. Tony, thank you so much for making the time and sharing your expertise with us. You've sort of given your details. People will know where to find you. We wholeheartedly would encourage any investor or potential investor to have those conversations. I've seen it personally dozens and dozens of times. As I said, when the property is purchased, it's too late. So it is part of the due diligence and the work that needs to be done upstream. Very grateful for your time, and until next time.
Well, thank you very much, Yannick. It's a pleasure, and always great to be invited to help your listeners out there and anyone in your network. And look forward to a continued long and fruitful relationship.
Thank you. Bye.
Thank you.